Thank you for joining us for our first quarterly economic update. We'll be doing this about 4 times a year in partnership with our Economic Advisor Eric Rosen. Many of you should be familiar with him from the Rosen Report, which is an incredible biweekly publication that um, we read, and Eric's been a great friend for many years. So what we'd like to do today is just give our update on the economy. Obviously, a lot's changing. The market's changing by tweet. A lot's changed ever since we put together our deck last week. Go in through our view of how we see the economy, especially through Eric's lens. And then we'll sort of take a look at it, what that means in the venture space and how we see some challenges and opportunities. The call is also being recorded. So for those of you that may need to hop off, we will distribute the recording probably by the end of the week or first thing next week. And then if you do have questions, this is a live audience chat. So feel free to use the chat, or you can actually chime in if you're on the computer. As we go through some of the slides, if there are specific questions, I think Eric prefers that you feel free to jump in right away. So if the topic's relevant, you guys can ask questions, and then we'll have plenty of time for questions at the end as well. So without further ado, welcome, Eric. Thank you so much for joining us.
Thanks, Mike. Happy to be with you all. And again, informal, please, if I say something that you don't follow or you want more clarification on, just ask a question. So what happened here is when Trump started, it looked like the economy was doing well when he came into office. And it was. I mean, behind the scenes, it was slowing down a little bit, but the headline, low unemployment, strong earnings growth, confident consumers and confident CEOs were definitely part of the picture. And then obviously that all changed in a hurry. As you could see, the recession odds went from, let's call it 20% to up to almost 70%. It's back to low to mid 50s, depending on the day. As Mike said, every time we do an update on these charts, 4 minutes later, they become a little less relevant with all the moves that are happening. And obviously the reciprocal tariffs, which we're going to go into in a little bit, created a lot of this pain. And we're already starting to see some pretty big earnings revisions. And although the earnings tend to be okay, their forward guidance tends to be pretty bad. It got very interesting. United Airlines said a couple of interesting things. One of them they said was that they've seen a 50% reduction in federal airline bookings because of DOGE cutting back spending. And two, they came out with two estimates for earnings, one if we go into recession and one if we don't, and they were fairly different. And, the DOGE coming into picture is also adding a new wrinkle because the federal government has been a net hirer over the last 4 or 5 years, and now they're laying people off. So that's a big delta. So next slide, please. So consumer economy, we've seen a huge fall off in consumer confidence. University of Michigan, the first chart, and then CEO views, the same thing. The CEO confidence, now 60% of CEOs see a recession in 2025. That's up. That's more than triple where it was 3 months ago. So we're definitely seeing more concern from the consumer and the CEO alike. Next slide. So this is a couple months dated, but I think it's still informative. Sadly, these things come out every 3 months, and we're just going to miss it by a day or two. But subprime delinquencies for autos is really climbing. I mean, if you look back, you have to get back to the late 90s to get anywhere near this level. It's actually higher than it was in the global financial crisis, which surprised me. A couple of things data points out of the auto sector that jump out at me. Number one, almost 20% of auto loans are 84 months, which, you think about a car taking a loan on a 7-year loan on a car, it's because they need to lower the monthly payments. Number two, almost 20% of loans are $1,000 a month. That's a pretty hefty payment when you look at how much people generally make. 0% deals are gone, and the average rate is 7% now, just over 7%. So again, starting to see cracks. And this is in January, just so you know that we're at 6.6%. So when I said behind the scenes, although things look pretty good, the consumer was starting to buckle a little bit. Next slide. Same is true. We're seeing some increases in credit card past dues. Really since the free money of a few years ago with COVID, we've started to see those increase pretty dramatically since then. And it's a consistent theme on past dues. Next slide. This one is student loans. And for those who don't track this data really accurately, there was a few-year pause on student loan under the Biden administration where we put a moratorium on student loan payments. And then they announced that you'll have, in a year, it'll start again. And that was for October of 2024. Since October of 2024, when the mandatory payments began again, we've seen over 15% of borrowers fall behind. And so to me, that's pretty dramatic if in just a few short months, over 15% of borrowers are falling behind. And we're now higher than pre-COVID levels. So another sign consumer is coming under pressure, and we really can't blame the tariffs on this one. And I think that only makes matters worse. Okay, next slide. I grew up with very limited means. My father passed away when I was 5, and my mother never made more than $14,000 a year. And I was always pushed by my mother to say, if you can't afford it, don't buy it. The growth of buy now, pay later scares me, quite frankly. And it's a program, you go to a store, you can't afford something, and they give you a payment plan where a third party charges the retailer for it. 60% of general admission tickets to Coachella this year were bought with a payment plan of some form or another, which I don't know, it's just concerning. Again, showing the consumer is really under pressure. Next slide. This is the personal savings rate, and you could see the huge spike in 2020, a lot of free money. Everybody's savings went up when they got a check in the mail. They spent it, then they got another check in the mail, and then they spent it. We are at levels below 2019. Personal savings has crashed. Interestingly, we see a little bit of a spike in the last couple months, and I think that's because of fears of a slowing economy, and people are actually saving because they're worried about losing their job. They're worried about what's coming. And so we're actually seeing a little bit of a uptick in savings, which is a good thing, but I think it's for a little bit of nefarious reasons. Next slide. So this is what everybody wants to talk about. As I said, when Trump came to office, the markets were euphoric, going to ease regulatory burden, probably lower corporate taxes and income taxes and extend the tax cuts, open up the floodgates in M&A. Linda Khan was viewed at the FCC as being a killer of M&A, opening up the floodgates for IPOs. And that's the way it was. Actually, the CNBC came out with a study, a big survey actually this week that showed in the 17-year history of the survey, there has never been a bigger move from optimistic to pessimistic on markets than there was between January and March of this year. So tariff policy uncertainty has clearly hurt GDP estimates, as well as increased recession chances sharply. But having said that, chaos creates opportunity. I was on Wall Street during 2008. It was actually record years for the business I ran in 2008 and 9. And I'm a big follower of Warren Buffett and his famous saying, be greedy when people are fearful and be fearful when people are greedy. People are fearful right now, and there's opportunities to be made when people are fearful. Next slide. So there's a couple of the next slides here as why I got concerned a couple of weeks ago. Historically, there's a relationship that when risky assets like equities or commodities or corporate bonds sell off sharply, treasury bonds rally and the yield goes down. Well, what we've seen 2 weeks ago, we saw markets selling off very, very sharply in equities, down 4, 5, 6, 7% on the day, yet treasury bonds were selling off too, and pretty sharply. In just a few days' time, the 10-year treasury went from 388 to 460. You just don't see those kind of moves when the broader markets are weakening. And I believe this chart was the reason that Bessent pulled Trump aside 2 weeks ago and said, guys, you got to call off the dogs here. And he put a 90-day reprieve on some of the tariffs. And I think this chart and the next chart, please, were the two reasons why. So this chart is the dollar weakness. So the DXY is a basket of currencies. The biggest one in there is the euro, the pound, the yen, the kroner, and a few others. And you don't see moves to the dollar go from 110. It actually hit 97.92 on Monday of this week. In a couple months' time, you just don't see the dollar, which is the reserve currency for the world, fall by 11% in weeks' time. So I think that chart, coupled with the Treasury move, is what really spooked Bessent to get Trump to call off the dogs. The chart on the left shows the foreign buyers, the foreign owners of U.S. assets. About 18 trillion of stocks are owned by foreigners, about 7 trillion of treasuries, and about 5 trillion of corporate bonds. And make no mistake, they were selling. There was a big story that Japan actually sold a fair number of treasuries. That was one of the issues that led to that big sell-off. And I wouldn't be surprised if China was in the mix too. Next slide. Okay. So inflation expectations. So I'm 55 years old. For those of you old enough to remember 1981, when the CD rate, the 6-month CD rate was 19%, mortgage rates were 16%, you had very, very high inflation. That's when Volcker had to raise rates umpteen times to stave off inflation. the rate that people are anticipating inflation jumped to the highest rate since 1981 on tariff fears. So it just shows the consumer and the CEO and those in the survey very nervous about inflation, which is another factor that's weighing on markets. Next slide. So I wanted to digress for a minute about something that I think is where the real savings are. A lot of people are talking about Doge saving a little bit of money, which is great. But to me, the entitlement reform is really, really necessary. When Social Security started in 1935, the average age of lifespan was about 61 years old. Today, we're 78. A Stanford study this last year showed that 50% of kindergartners today will live to 90 years old. Well, I don't think Social Security, when it started in 1935 on the heels of the Great Depression, anticipated people living that long. France last year raised the retirement age by 2 years. I think that's one of the three things we need to do to stave off Social Security. The other interesting factor is we have gone from 16 workers per retiree to 3 workers to retiree in the last 50 years. Our fertility rates are crashing. In 1960, average fertility rate was 3.6 times. We are at all-time lows in the United States. It just came out 1.66 times. So families are having 1.66 kids down from 3.6 kids. And that is obviously contributing to the woes here. Next slide. This just outlines that entitlements are basically 80% of mandatory spending and crowding out everything else. And that's why it's so imperative that we have to make some tough decisions. And sadly, neither party is willing to do it. Next slide. This is a friend of mine named Mike Semblis. I don't know if anyone follows JP Morgan. He's the head of strategy for the private bank and asset management, a very bright guy, puts out some amazing charts. And this chart just shows how the growth of entitlement spending to 2035 and how much it's outpacing non-discretionary spending. It's just my case in point. This is where the tackles have to be made in terms of cost savings. And again, it's raising retirement age, it's means testing, and it's also raising the cap on contributions, I think, are the three things that you have to do. Okay, next slide. And this is the federal debt. We're at $37 trillion. We're growing at $2 trillion a year. We have been running deficits of about $2 trillion a year in the last 4 years. And then the CBO just came out and said over the next 10 years, we expect $22 trillion of deficits, which would be $2.2 trillion a year. And they always guess low. They're never right. They never guess high. And so best case, we're going to be at $60 trillion of debt over the next 10 years. And I just don't think that's sustainable. We've been running deficits to GDP of about 7%. I'd feel a lot safer at 2 to 3%. Besant came out today and said those words, I'd like to be at 3% or lower. Back to Warren Buffett, has a great saying. He said, if you want to end 7% deficits, it's very easy. Make Congress unelectable. They can't run for re-election if the budget deficit is more than 3% of GDP. It's brilliant. Sadly, it will never pass, but that's the way to go. Next slide. I'm an equal opportunity hater. You look, the last time we had a balanced budget was under Clinton in 2001. Fiscal year ends in October, so that's why it's 2001. He left office in 2000. Bush ran deficits, albeit small, few hundred billion. Obama ran bigger deficits, global financial crisis. Trump ran a little bit smaller deficits until COVID happened, and then it was over $3 trillion. And then Biden ran pretty healthy deficits between COVID and a lot of the programs he had, finishing in 2024 at $1.83 trillion. And so I just would like to see both parties show a little more fiscal restraint. I think Doge goes a little way towards that. The savings in Doge as of 10 minutes ago when I checked was $160 billion. Great. They were talking $2 trillion. If we get to $500 billion, I'm doing backflips. So, and also Musk basically announced today that last night that he is going to be stepping aside from Doge in the next couple of weeks to focus on his day jobs of being CEO of multiple companies. Next slide. So how am I playing the volatility? I am buying on weakness. In my trust, I bought a lot of stocks when it was down big that day. I tend to play on big down days. And I'm also in my family office. I'm doing a lot in private deals with respect to private lending, hard money lending, and looking at people who are stuck and trying to, find people who are in need of capital and willing to pay up for it. Next slide. I really like this slide. I'm using Mike Semblist again. It basically shows It basically shows what happens after a big drawdown. So when you look at a 15% drawdown in stocks, 1 year forward, 83% of the time you make money. If you look at a 20% drawdown in stocks, which is where we are about now, not 87% of the time you make money after 1 year. And if you look at a 25% drawdown in stocks, you are looking at a 93% success rate, and that success rate is around 12%. So it's basically saying when you have a big drawdown in stocks, chances are you're going to make money, not necessarily over a day, a week, or a month or two, but over a year or more. And if you'll take some kind of a medium to long-term view, you're going to make money. I'm going to pause because I see a question. What percent of national debt is new spending versus compounding interest? So the interest, and I'm going to go on a little diatribe here, interest is going to run about $1.2 trillion this year. And so our budget is $7.3 trillion for 2025. And so we're going to do a little over $1 trillion of interest. So we're running almost 20% of our budget is on interest. We had an amazing opportunity, and I write this newsletter twice a week. It's a labor of love, read in 50 states and 105 countries. And I was very critical of the Treasury Department, Yellen, for not refinancing our debt in 2020, 2021. Remember, the 10-year yield hit 33 basis points. The world was scared. When the world is scared, absent what's happened the last couple of weeks, Treasuries rally. The 10-year got to 33 basis points. It's trading at 440 today. We could have issued as many bonds as we wanted at 50 basis points, at 70 basis points, at 1%, and refinanced all the debt that we have coming due. Because her, in her infinite wisdom, and Powell thought that this was transitory, we really didn't refinance any debt with long-term debt. We refinanced it with short-term debt. And now that short-term debt is coming due that was 50 basis point, 100 basis point debt, and is now being refinanced at 4 or 5%. And that's what's killing us. And so not only is the amount of debt that we have killing us, the interest rate that we're paying is killing us, and it's just going up over time. So great question. And sadly, we're spending way too much money. And if you look at a chart of history, we were spending almost nothing. We weren't running deficits until the 80s. We didn't, as a country, the first 200 years of existence, we basically balanced the budget. It was only in the last 40, 45 years that we started running deficits, which is, and really, if you look at the chart, that I showed before on the amount of debt, we were at like 8 trillion. Go back a few, keep going. Yeah, that one right there. So yeah, that one. So if you look at in 2010, we were like 8 or 9 trillion in debt. We're now at 37 trillion. Now, part of that was global financial crisis. Part of that was COVID. But part of that's just careless spending. I personally do not think we have a revenue problem. We have a spending problem. And I write a lot about that. So let's go back to the next slide. But good question. Okay, we got some more questions. What are the risk factors to the bond market that is showing signs of weakness? So to me, the risk factors are really, we are starting to see a breakdown, and we're starting to see a breakdown of market relationships that generally hold true. And I touched on that earlier. I got to tell you, if I want to play hardball and I'm Xi Jinping, I'm selling U.S. Treasuries. I mean, there's a few things I'm doing, but he owns $1.4 trillion of U.S. Treasuries. Not only is he not buying, he starts selling, and he pushes that yield up. That makes Trump blink. That's what I would be doing. I would withhold antibiotics. Some of our antibiotics that we use, 90% of them are made in China. He's already just withheld rare earths that are used in EVs and all the robotics. So Musk came out in his call yesterday and said, without China's rare earths, we can't build EV batteries and we can't build the Optimus Prime robot. So if he wants to play hardball, I think he could do that by selling treasuries. And I really watch the 10-year treasury market. And I also watch the rate between the 2-year, 10-year. I study the 2-year, 10-year relationship. Generally, when you think about it, if you wanted to borrow money for 5 years, you'd pay more than if you wanted to borrow money for 6 months. So there's an upward sloping curve for rate borrowing. Before recessions, every time other than last year, since 1976, when the 2-year yield outpaced the 10-year yield, we've had a recession within months. Every time. Every recession since 1976, you've seen the 2-year yield outpace 10-year. It's a recession. The only time it didn't happen was just this last time. And it's because we're running massive deficits. The only reason we're not in a recession the last year, you're running $2 trillion deficit, 7% of GDP. You're staving off that recession. But I look at that relationship. Okay, let me see. From a family perspective, office, how will you how has your appetite changed when it comes to backing VC funds, PE managers in this environment? So, for me, it's funny. I'm gonna tell a story that's a little bit embarrassing, but I don't mind being self-deprecating. So, I made my first venture investment in 2007. I thought I wrote it off. I thought I got a zero. I got a check for 45 times what I put in to the venture investment. So all of a sudden now I think I'm Kleiner Perkins and Sequoia. I think I'm the best venture investor that has ever lived. So then I went out and I took that money and I made a bunch of venture investments. And all I'll tell you is I have not done nearly as well on the subsequent venture investments as I did on my first one that I thought was a zero, that was a 45-time home run. So I tend to have a barbell strategy. I have stocks, I have fixed income, and I do most of what I do is hard money lending. I get people who are in pinch of capital and I lend money against it. If I'm playing in PE today, I tend to go out, and we're going to talk about this in a minute, go buy secondaries, at discounts. Like we're going to talk about it shortly. A big school is selling a $6 billion portfolio of PE. I tend to play it that way, rather than I'm VC, because I have made so many VC individual investments. I'm not as big of a VC investor today as I was, only because I was overexposed. Let's see. The tariff pause is ending in 70 days, supposedly to allow trade negotiations. What do you expect will be the outcome in about 2 months? So I will say this. If we are having a conversation in 60 days about tariffs, there is a 100% chance we're in a recession. There is no chance that we're not in a recession if we're talking about tariffs in 60 days. And so Torsten Slok, chief economist at Apollo, used to be chief economist at Deutsche Bank, was on CNBC yesterday before, basically said, if tariffs aren't over soon, we're going to be in a recession. He did put out a chart this week on Monday in his Daily Spark, and I would suggest everybody sign up. If you're interested in economics, they put out a great little short chart and a paragraph on it. It'll take you 2 minutes to read, but it makes you smarter, for the Daily Spark. And it showed that the average time of negotiation a trade deal, and I had no idea before I read this, I'm stealing Torsten Slok's thunder, was 18 months to negotiate and 45 months to implement. I can tell you now, if it takes us 18 months to negotiate and 45 minutes to implement, and we are talking about massive tariffs, there is not going to be your garden variety recession. I don't think that's going to happen. But if that chart holds true for this case and he keeps backing off, Trump keeps backing off, and that's why the markets rallied today. They're off decently from their highs. The S&P was up 182 at the peak this morning, and it closed up 88. So people just don't trust it. He's on again, off again, and he makes it confusing. But I definitely feel that this tariff information and this tariff craziness has to be solved very near term. And I think, if I'm being intellectually honest, Bessent is the adult in the room in this administration. He is the smartest person in the administration, and I don't see a number two. And this guy is very, very savvy. He worked for Soros, ran a successful hedge fund, and I think he's the one who keeps pulling Trump aside and said, no mas. And I think that was what happened 2 weeks ago when rates backed up and currency got killed. And I think it happened again this weekend. He had conversations with him. Okay, to build on the comment, are there many specific characteristics or strategies you're prioritizing on more when evaluating managers? So to me, when I ran a hedge fund, I had $1.5 billion hedge fund that I ran for a number of years. And I like to say, well, how did I raise money? And I tried to be differentiated. What's my story? So first of all, I'm investing in people. I'm investing in the talent. Do I believe that the talent is good? Do they come from the right pedigree? Are they differentiated? What are they bringing me that somebody else doesn't bring me? And do I like them as people? Do I trust them because I'm giving them my money and I worked hard for my money? And so, those are the things that I look at. And on a macro level, do I want to be allocated to the space? Because I'll be honest, I launched a hedge fund. And I'm friendly with a guy named Dan Loeb, who's a very successful hedge fund manager. And when I announced that I was launching a hedge fund, it was a story on Bloomberg. He called me, said, I'll come over tonight for dinner. I want to celebrate with you. So we went over to dinner. And Dan, who is clearly a little bit smarter than I am and a lot more successful, said, Eric, I don't think now is the right time to launch a credit hedge fund. It's time to be in equities, not credit. Well, my timing wasn't great because I launched a fund with $500 million I raised to launch the fund. I put a very meaningful portion of my liquid net worth in the fund. And returns just were not there to be had. I was making 5, 6, 7% a year because the high yield market was yielding 5%. So it was really hard to make money. Every fund that launched the year I launched closed within 3 years. I lasted 8 years or 9 years, and I was like a hero for lasting that long. It's timing is a big portion of it. So you have to look at the macro aspect. Is now the time? So we're going to talk about it, but if you invested a bunch of venture in 2021, chances are you didn't do as well if you invested in 2016 or 17. So, I think vintage plays a huge portion in your allocation. Okay, another new message. Keep the questions coming. Love the fact that it's interactive and you guys are engaged. Assuming we do enter a recession, do you think private market valuations have fully adjusted to the new macro regime? Kasra, I love this question. I've written multiple newsletters on this. I traffic in illiquid assets. I ran credit trading at JP Morgan, the distressed business. I ran a $7 billion global distress book where we traffic in illiquid securities and non-securities. There is no fund. I'm going to repeat it again. There is no fund on the planet that on private credit and some of the stuff is marked perfectly because it's an art. It's an art, not a science. It's very hard to do it. And actually, there was a big fund who you can check Wall Street Journal. I won't say the name, but it's a fund that everybody on this call knows. Came out during the carnage of COVID, and they had built. It was a hedge fund that was supposed to be liquid, and they put 50% of their assets in private equity and venture. And they said, amazingly, our public market portfolio is down 44% on the quarter, but our private market portfolio is only down 5%. Now, I just started laughing hysterically. Like, of course it's down 5% because you didn't mark it to market. But if you mark it to market, like it's probably down 70%. And so, you got to take a long-term view because, there's not a lot of liquidity in this stuff and you got to take a long-term view. But I think most of the folks that are trafficking in these illiquid assets, they don't market to market. That's a brilliance of the private credit business. They don't have to market to market. And so if you are allocating to private credit, I would just ask that you follow managers and invest in managers that have been through cycles, that have restructuring expertise, because there's not a lot of liquidity in these assets. And so they have to work them out. With a venture deal, if it goes bad, you write it down, you don't put any new money in. In a credit deal, you might have to put in more capital. You might have to restructure it and take equity. There's different things you have to do, and you just got to make sure that you are backing a manager that has that experience. Okay, I think I got through all the questions. And thank you for asking. I love that. Let's go to the next slide. So I just thought this was interesting. I did a piece on this a number of months ago. And what this says is it shows that the number of workers that the S&P 500 companies need to generate 1 million in revenue. So in 1985 was about 8.5 workers, and it got down to 2 workers in 2024. So what does this mean? And what are the ramifications? So one, it means we're far more efficient than we were. Smart computers, smartphones, automation, robots, all those things have played a role in making us more efficient, which means that companies' margins are better and they're more profitable because of this chart. I will ask you all to put your I'm going to date myself, but my favorite was the Great Karnak of Johnny Carson's skit where he would predict the future. Put your Great Karnak hat on and think about what this chart looks like 10 years from now. If I'm putting my Great Karnak hat on, I'm telling you that this chart looks like 0.5. I think we'll be at a half a person to generate $1 million of revenue for the S&P 500 companies, down from 8, what will be 40 years later or 50 years later. When you look at the growth in AI, it came out today, there's a school in London that's $35,000 a year that will teach classes with AI tools, no human teacher. In Houston, Texas, there is an AI program that started 2 months ago to tutor children. Children's test scores improved by 30% over 2.5 months. I mean, these are statistically significant moves. And my favorite story is to the question about VC investments. I just missed a huge one. 1 year ago, one of my readers brought me Figure AI. For those who don't know, Figure AI and Optimus Prime at Tesla are the two duking it out for robotics dominance. And I got shown the deal at $1 billion or $1.5 billion valuation. And I quite frankly, didn't understand it. Was over my head. I didn't do it. It was literally last March. This March, they raised money at $30 billion in 1 year. And what I like about them, and it ties in with this chart, is they have leased robots to Amazon. And Amazon, I believe Bezos or Amazon invested in the last round of Figure AI. When you have a warehouse worker, that warehouse worker with salary, overtime, benefits, sick days, 401k, matching, pension, blah, 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 it's like 130 grand a year. One robot replaces 3.5 people, and it's $50,000 a year. The robot works 23 hours a day, needs to be charged for an hour, no lunch, no sick time, no phone time, no 401k matching, no pension, and no overtime. So if you don't think that there is going to be a massive deflationary pressure in the world on an aging population coupled with fewer laborers that they can do teaching, they could do warehouse work, they're going to be driving a car. One of the biggest jobs that Americans in the world is a driver, truck driver, car driver, UPS driver, FedEx driver, mail truck driver, delivering the mail. As we progress with self-driving and it becomes better and better, what does it look like 10 years from now? There's millions of Uber driver, Lyft driver, taxi driver. There's millions of jobs. So I just thought this was an interesting chart, and I wanted to kind of end this section just to give you something to think about and the impact and what things might look like 10 years forward. Okay, hold on. No, I got all the questions. Next slide, please. So I talk about credit market booming, the private credit market booming. We had $2 trillion in private credit. I started in the credit business in 1992. For those in Chicago, it was at a firm called Continental Bank. I'm dating myself. And, private credit is booming. And the big benefit there is they don't have to mark to market. And so their returns look a hell of a lot more steady than a fund that's buying bonds or loans that are marked to market on a daily basis, on a broadly syndicated basis. There was a 46% annual decline last year in the number of new venture funds raised from 21 to 24. And, we're seeing fewer new funds close. Mike came up with this statistic from Carta. Over the last 3 years, the annual count of investors who made at least one new investment in a U.S.-based startup declined by 26%. I think that's interesting. And also, we're seeing less distributions, and that's going to tie into the next couple slides, but we are seeing fewer distributions. If you, for instance, 21% distributions from the 2020 vintage versus 37% from the 2017 vintage. So you're seeing M&A fall dramatically. Next slide, please. Look at the IPO market in 2021 versus 2022, 23, and 24. We're talking about fractional. We were starting to see a pickup in 2025, about $10 billion of IPOs. In the last few weeks, you had CoreWeave and Newsmax that started off both pretty hot. Newsmax went from, 10 to 300 or something in short order. It's back down dramatically, down 95% from its highs in a matter of weeks. And CoreWeave suffered the same fate. With all this tariff uneasiness, vol where it is, the VIX is hovering, hit 51 2 weeks ago, and it's hovering in the 30 range. It's very hard to do IPOs. And I didn't put the chart in, but if you look at IPO performance relative to the S&P 500, IPOs are massively underperforming the S&P over the last 4 or 5 years. It doesn't make, people want to perform. I didn't put the chart in. We had a problem with the chart, but if you look at this chart and you were to say, what does M&A look like? It's not this pronounced, but 2021 M&A, it looks like a big bar. And then 22, 23, 24 is down about 40% or so from the 2021 levels. So why is all this capital trapped? And why are you not getting the distributions in some of these private equity and venture funds? It's no IPOs and a significant reduction in M&A activity in both deals and volumes. So I had thought when Trump was elected in November, and I think the market thought that the euphoria from the November election to January was around lower regulation, around Linda Khan being out of the FCC to open up the floodgates for M&A, around IPOs, around lower taxes. And none of that has materialized because the thing that's taken over more than anything else is tariffs. Okay, next slide. This is a little bit more pictorial about the trapped capital. Firms are sitting on a record number of deals that they want to sell. The green bars, they're trying to sell almost 30,000 companies in private equity, which is a big number. And then when you look at the amount of cash, ratio of unspent cash to value locked in unsold companies, it's it was at 90% in 2000, and it's at, let's call it 35% today. So what we've seen is Yale is actually in market trying to sell a $6 billion portfolio. I believe there's going to be a lot of opportunities in these secondary sales. When I lived in New York City on the Upper East Side, one of the people who lived in my building, it was a woman who ran, I think, the biggest secondary portfolio of buying private equity stakes and she made a ton in 2009 and 10 on post-global financial crisis when no one could fund them. She was buying these things at 10, 20 cents on the dollar. And I don't know what her return of her fund was, but it was massive multiples. It was a massive home run. And I think you're going to see more and more Yales of the world. There's actually talk of Harvard $53 billion endowment. Trump is battling a lot of these Ivy League schools over their anti-Semitic, how they've treated anti-Semitism, and talking about cutting federal funding. I personally did not know that the government was giving billions and billions and billions of dollars a year to these huge schools, but they were, and he's paused that, and that is leading some of these schools to sell their portfolio. And I think you're going to see more of that over the next year if that funding does dry up. Okay, next slide. I'll turn it over to you, Mike. And if there's more questions, just chime in and I'll answer them.
Hey, thanks, Eric. Just to capitalize on some of the stuff you said, this slide's very interesting because it shows, and this is a subset of Carta, but it's a representation of the market. But if you look at that time period in 2021, you'll see in a period of 1 year, almost 3 years of capital was raised in the private market. I mean, that's pretty substantial. So when you look at the amount of trapped capital that's in the system, this really ties back to some of the statistics Eric was talking about in the M&A market. And that was part of our motivation for where we saw opportunity to come in. A lot of these firms, PE firms, and obviously VC firms, they're all intertwined, are having a hard time with some of their valuations. Some have chosen not to mark to market theirs from 2021, but you saw the euphoria that came in the system and a lot of this capital chasing really sky high valuations. So part of our strategy is, look, it's a lot of opportunity. I think what Eric said is there's a lot of great years that are vintages for some reason because you're coming in the aftermath when pricing comes down dramatically. And that was a huge area of opportunity for us. I mean, we saw in late 2022, there were some strong signals on some of these early stage companies that were being started. And our whole philosophy was, look, we don't want to catch falling knives. We want companies that are being started in this environment, right? Real entrepreneurs are going to step up and come to the table and build these businesses in difficult environments. And I think we're starting to see some results from that. Although you still see capital is a little elevated in 2024 based on the historicals, a lot of that has to do with some of these really high valuations. And, when Eric was just talking about Figure AI, the one opportunity he missed, sorry, Eric. But some of these companies are raising at extremely high valuations. There are some elevated valuations, and I'll kind of explain our strategy in the next slide if we can move on. You'll see here, this just shows this is a nice slide because it shows you what's the average AI seed valuation versus non-AI company. Obviously, seed stage is the area that we're focused on. We think it's a great opportunity for many reasons. You've seen a lot of less flux in valuations at the seed stage, predominantly because these are where companies are starting. So you'll see a lot less fluctuations because, they have to raise on a certain multiple. But you're starting to see a lot less cash raised in the seed round. So some of these valuations are starting to come down a bit, but there is a flight to quality. So it is becoming harder to get in the higher quality deals. And, thankful to our network, we've always had access to these deals and we continue to do so. But if you look at on average, your average AI valuation at the seed stage is about 50% higher than your non-AI valuation. So that's significant. So part of what we look at is we want to make sure that obviously we're getting in at attractive valuations with the right companies. But you'll see that that's a statistic that I think carries weight across the entire market. On vertical AI, so many of you know that's one of the areas that we're really focused in on right now. I think from a vertical AI's perspective, it's in my opinion, I think we're starting to see the industrialization of AI. And so there's a lot of AI. AI is a big word out there, right? And a lot of people don't necessarily understand it yet. And they get too caught up in the hype of, they see the Figure AIs, they see the Chat GPTs raising at these monstrous valuations. there's so much infrastructure that these AI companies need to build. I mean, they need to raise billions upon billions to build this infrastructure. But there's also risk at commoditization for a lot of these companies as well. And so when we look ahead and we look at where AI is going, we really see the companies winning aren't going to be the ones building general tools. I think they're going to be solving for concrete problems in healthcare, finance, logistics, legal tech. And really, our focus is purpose built AI that understands the nuance of these sectors. So essentially, our whole strategy is obviously investing in real businesses, embedding in AI, and it's defensible IP. There's a lot of these wrapper companies that are AI, great for the consumer and business. I mean, it's unbelievable. And how many note taker apps are out there? So, as a consumer myself, when we conduct business, the speed of which we can do things and the efficiency is amazing. And literally in a month, there's another tool that's coming out that's better than the other one. And there's just a ton of churn. And so a lot of these high valuations, especially in AI, are coming from these companies that are coming on the scene and producing 30 million ARR in the first year. I mean, that's significant. But if you look at the longevity of where that ARR is going, it's there's a risk of it going to the downside as fast as it came up, because the development of AI is moving at such a speed where every application has just become better and better. So we just don't see how that's an attractive area to invest. We continue to believe that focusing on the verticalness of this business is really what's going to produce returns in the long run. It's capital efficient as well. I mean, look, you see all this news about the tariffs. I don't think any sector is immune to tariffs, as Eric said. And obviously, pricing is going to be effective whether we enter a recession or not. That no sector is immune to a recession, but obviously there's ones that are more immune than others. But there's a ton of capital efficiency with AI. I mean, Eric saw that chart that was amazing. I mean, you saw the number of humans needed to produce millions of dollars in revenue, and it's just continuing to go to the downside. And I think that's going to be more prevalent in some of the businesses that we look at. And obviously technology that's deeply embedded in the companies. I think that's really important because it's defensible IP. You see now one of the best areas of opportunities, at least for someone getting a job out of school, was to be a developer. Some of these developers were getting paid, 150 to 200K out of college to go, develop technology for a lot of these B2B SaaS companies. Now that whole profession's at risk. I mean, you're looking at AI coming in and being to develop some of these technologies at almost 90% of the cost that it used to be. And so, one of the greatest quotes that I see and we live by in terms of how we make our investments is, don't be scared of AI taking your job. It's the person that knows how to use AI that's going to take your job. And I think that's important. And then as we look at these businesses, they're high value, high margin, but it really becomes the defensibility of IP. A lot of these AI companies, you need real expertise on your team to really understand the technology. Because if you don't peek under the hood and see what they got, that business can be displaced in a matter of months at the pace this is moving. So next slide, please. Just to wrap it up, sort of the challenges and opportunities. I know we gave a whole view of the macro. I think from our lens, it's very important. As we focus on the VC space, obviously that's what we do. We run an early stage VC fund. What's great to have people like Eric on our team is we love to take a whole view of the macro, right? It's very important in terms of the investment decisions that we make, but also the sectors that we choose to focus on. If you look at some of these tariffs, the logistics space becomes an interesting area to focus on. So as we look at being sector agnostic in terms of focusing on vertical AI based on where the economy is going and what types of policies our friends in Washington, D.C. Want to put forth, that really helps us lean in to certain sectors where we think there's going to be even greater opportunities. But when you look at the challenges out there, obviously fundraising, it's a very difficult environment to fundraise. We're very thankful we've had success in fundraising, I think based to our strong thesis and the companies that are performing in our portfolio. But the one thing I'll say to that is that fundraising has become a new checkbox in terms of making investments. Whereas when you made investments previously, it was automatically assumed that good companies could fundraise. And that's not necessarily the case. You have to look for founders and teams that either have a strong network, strong cap table, or they have the ability to fundraise themselves. because if they don't have the ability to bring more oxygen into their tank, as good as their business could be, it could be at risk in this type of market. Market volatility impacting IPOs and M&A, that's been a cornerstone of our thinking from day one. We came in after that whole 2021 era, and IPOs were an afterthought for us. If one of our companies goes IPO, I think that's just icing on the cake. But our whole goal is to align ourselves with disruptive businesses, real businesses that are making a dent within their sector that'll be acquired, right? And that's really how we go about looking at anyone coming in right now that's making early stage investments, thinking that, with the underwriting, with the hope of going IPO, I think is going to be significantly challenged. Obviously, it's rapidly changing due to advances of AI. I think that we've beat that to death during this presentation. And then the tariff uncertainty. I think we're asset light the way we invest. I think that's a strength. But I think the way we look at tariffs is, okay, well, which sectors can we focus on where we might be able to see outside returns? Opportunities, early stage focus. I think early stage tends to be more resilient. I think our philosophy has been shown to be the right way. You see a lot of these larger VC funds have been focusing on the earlier stage. The problem is a lot of these bellwether VC funds can't focus on the early stage anymore because they raised so much capital. I think it's like 6 VC funds took in almost like 50% of the capital raised in 2024. So their fund sizes have become so big, they're having a challenge allocating to the early stage space. I think that's a huge opportunity for a fund like us. Smaller checks and the biggest players won't focus. That's true. I mean, look, as I like to say, when we make investments, we might not be the largest check, but sometimes we're the largest mine. And I think that comes to a fact of the VC funds that are going to get access to deals and win in this type of markets are going to be the ones that can provide true added value. Also, better terms and valuations. I know you saw the AI slide. Obviously, those are higher. But yeah, I mean, for some of the companies right now, it is, terms are on the sides of the VC. When you have the right VCs there, you can definitely attract better terms, and also, work in pro rata amounts and other things that can help, keep your ownership size steady over time. Being sector agnostic, I think part of our sector agnostic approach, around 2 years ago was that we saw challenging economic times ahead. And I think being sector agnostic within the part of the VC fund allows us, our whole portfolio doesn't necessarily become at risk if we're focused on a space that can be challenged based on whether it's tariffs or certain recessions or certain economic policies that are passed down. And obviously with AI, disruptive tech is going to lead to new opportunities. So with that said, I don't know if anybody has any additional questions, but I wanted to, thank Eric for the great presentation. And we do have more as well here. So
yeah, so I see another question here from Kasper again, going a little deeper. Assuming we do enter recession, do you think private market valuations have fully adjusted to the full new macro regime? And so I would just say, yeah, I touched on it, but yeah, I feel like I would be careful. Those are things you buy in the secondary. If you have a fund that has a public and private arm and they're taking new capital, I would really ask to see the valuation and just randomly pick 3. And how do you justify that being marked at this price, and see if you feel comfortable with it. And if you do, that's one thing, but I would be surprised if you do. Colton, you mentioned a number of industries already seeing traction with vertical AI. Curious if there are any specific use cases or sectors you believe are especially primed for breakout growth over the next 12 to 24 months. Mike, why don't you tackle that one?
Sure. No, great question. I mean, look, you look at a couple of the sectors. I mean, logistics, right? I mean, that's a space that's ripe for disruption, as some of the slides you saw from Eric. Legal tech, that's another space that's we think is ripe for disruption. And I think more is going to change as you see what types of policies are being handed down. But there's so much opportunity within the vertical AI space. I think it's really capturing your hands on who are the best entrepreneurs equipped to build these types of businesses, and then owning in on the sectors. I think we usually take our cues from some of the economic data that Eric presents on where we want to go a little bit deeper in those spaces. And I think Bruce had another question, Eric.
Okay. Please address the perceived war that Trump is waging on Powell and the effect on markets. Also, do you feel that energy sector in regard to AI is being overlooked and undervalued? Okay, so the thing I just published recently today, and then the last piece, I am an equal opportunity hater. I'm very hard on Biden. I'm very hard on Trump. I'm hard on all politicians because I think they all are degrees of bad. What Trump is doing to violate the independence of the Fed is the reason the markets got killed. Today is Wednesday, so it was Monday that they got killed. 100% was that was it. He called the chairman of the Federal Reserve a moron. Now, I don't think the president should call anybody a moron, let alone the chairman of the Federal Reserve, even though I don't believe Powell should be the chairman of the Federal Reserve. I thought the mistake he made by calling inflation transitory during the COVID would have made him, he wouldn't have been my choice for the chairman of the Fed. I find it troubling. Austin Goolsbee, the president of the Chicago Fed, was very, very critical of Trump and trying to violate the independence. I am not convinced that we should be lowering rates today. I believe we will be lowering rates in coming months, but the uncertainty of these tariffs, whether it's going to cause inflation, whether it's going to stick, I think Powell is very heavily weighing what happened in the 70s when we had runaway inflation and Volcker had to raise rates so many times. Yes, rates are going to come down this year, but remember, rates are already down. They've already been lowering rates now for 6 months, and the 10-year's materially higher. So just because you're lowering rates, the bond market is telling you where the 10-year's trading, and it isn't. The Fed funds is down, 75 or 100 basis points, and the 10-year Treasury is up over 100 basis points. So just because they're lowering rates does not mean that's going to work on the long end. And then also, do you feel that the energy sector in this regard to AI is being overlooked and undervalued? I mean, I don't want to specifically, I don't have a strong view on the valuation of the sector. Parts of energy are getting eviscerated right now. Look at oil. I mean, oil traded at $57 a barrel in the last week or two over the fears of a global slowdown. Commodity prices like oil tend to get crushed in an economic slowdown. I bought Chevron stock 10 days ago when the stock market was down 8 or 10% that day. Chevron was one of the stocks that I bought. I bought a commodity ETF. I'd tell you if I remembered which one I bought. But so I do think that the demand for power is unreal. So I made a loan to somebody who has a huge solar project underway. And it is a huge solar project in Texas. The amount of parties that are circling around to get access to this power is just mind-numbing. And it's because, one, the ERCOT power grid sucks, pardon my French. It goes down all the time. And with the need for all this AI is a huge consumer of power, you really need more. And generally, things like wind aren't consistent enough. If the wind doesn't blow, you saw that in the North Sea. But Texas sun is pretty consistent. And so it needs to be more efficient because grid power is very, very expensive. And there's been a vilification of of natural gas and coal. I think 61% of our power grids run on coal or natural gas. So it's not, they're very, very heavily weighted towards that. Nuclear power is the answer. If you're asking me what the answer is, it's nuclear. Look at what happened in France. In France, they went nuclear. Germany didn't, and Germany buys power from France. And France is growing, and Germany is under siege. So I do think a combination of some alternatives, but nuclear is the way I would go. Is that everything? Did I get? Oh no, there's more questions. Thank you, Mike. Okay, Eric, a follow-up on private markets. Are you seeing LPs or GPs take advantage of the perceived on-sale environment for U.S. high-quality bonds, and how might that crowd out capital from Go Stage or fee? Listen, I think everybody has an allocation, the standard 60-40 equities and bonds to somebody who's earning a living. And then as you get older, it moves to more of a fixed income. We put, I advise some different families on allocation, and there's a family with somebody in their 80s. And I took them all out of equities and put it all into fixed income because they had a material enough that they were getting so stressed by the volatility in the equity markets. I did that, and they're doing quite well. So I would say, yes, there is, but I don't think bonds are super cheap. The high yield market I looked today is yielding at about 8.5% for an unsecured bond. If you're going to recession, I think that goes lower. So I don't think the high yield market's incredibly cheap. I think some of the private credit markets are still cheap. You could get, teens returns secured, and I like that a little better. Given the current macro environment and tightening liquidity, are you seeing a shift in how angel investors are thinking about capital efficiency and runway at the pre-seed level? Are there new signals or founder qualities that are standing out now more than previous cycles? So, Mike, why don't you take it, and then I'll chime in.
Yeah, no, I think I alluded to this earlier. I mean, fundraising is a checkbox, right? So are these founders and co-founders, and are they able to fundraise? But yes, I mean, everyone in the past year at this stage has been capital efficient. If you're not capital efficient, you're really not fundable. But fundraising is a new strategy, and it's not easy. So you have to get these founders to really think ahead. If you look back to 2021, and what was happening is that everybody was raising in a matter of 3 months. So they were just waiting to run out of money, and then they would go back and raise in a short period of time. That's not happening now. And so you have to have really strong founders that are planning years in advance. They have a plan to get break even or cash flow positive. And but yeah, no, it's the real shift is how these founders are able to fundraise. That's something that you have to factor in when making these investments at an early stage.
Yeah, and I mean, I think it's always consistent. I've got to believe in the person. If I'm trusting you with my capital, I've got to believe in you. How you differentiated? What do you bring to the table? What about your team? What are interesting deals? So, I was always reading the room when I was raising money. I think raising money was one of my core competencies. And I would read the room and the kind of questions people would ask me and what they were looking for. And I think I want people to be tight. And when I say tight, so when you ask a question, so an investor would come in and say, "Oh, can you show me, the last investment you made, how you came to that conclusion?" I pulled out a book. That book had all of our analysis in it with charts and graphs and why, and our memo, our investment memo, and why we did it. Like, we were tight. And I feel like that breeds confidence. And if you make a mistake, you could fall back. Okay, this is my thesis. This is what went wrong, and try not to make the same mistake again. So, and I also think, as when Dan Loeb said to me, you probably shouldn't be starting a credit fund in 2013 with high yield at 5%. I think a lot of allocation is being in the right place at the right time. You could have been the worst hedge fund investor of all. You started a hedge fund. A friend of mine started a hedge fund in January of 2009. He launched with 500 million at the lows of the market. Is he a genius? No. His first year return was up like 75%. He looks like a genius because his timing. So I think part of it is being able to allocate to the right asset at the right time is very, very important to outperform the market. And AI is hot right now, and there's going to be some big winners. There's going to be some very, very big winners. In that space over the next 5 years. Let me see. Do we have more questions? Did I get? Thank you. Okay. I'm glad I'm up with you. Brought up the 60-40. With U.S. markets under pressure, inflation lingering, and the classic portfolio mix underperforming, how are you thinking about positioning over the next year or two? Are you leaning more towards cash, real assets, or international? So listen, I'll tell you where I was wrong. I did not see Trump blowing up the world on tariffs, and I did not see the dollar getting eviscerated. Quite frankly, I'm going to Europe this summer, and I was very excited about how strong the dollar was and how cheap everything was going to be. Well, that all changed in the last few weeks. So now it's going to be a lot more expensive vacation. And so I believe that you need to have in the 60-40 portfolio, you have to have some international exposure. I would say that personally, I am underweight internationally because I have such a big part of my net worth in these hard money loans. I do it myself. I don't have a team anymore. It's a family office of one. I don't do anybody. I do all the documentation. I have a lawyer that I've hired. Doesn't work for me directly, but I hire them by the hour to help me document these deals. And I'm getting, for me, mid-teens returns, which is all I care about. If I could get 13, 14%, 15% and sleep at night, that's how I live. So I no longer go to work every day. That's one of the things I do. I make investments in real estate. I develop some stuff. And so I'm not as active in international markets as I used to be because you really have to follow them. But that's a good segue to reserve currencies. I did a piece on this my last piece. I actually wrote about reserve currencies. So in 1900, 84% of reserve currencies or something, or maybe more, was in the British pound, and very little was in the dollar. By 1947, the dollar became about 50% of reserve currencies. By 1973, it was 84% of reserve currencies was the dollar. Remember, 73 years earlier, it was 84% was the pound. And today, you have about 59% of reserve currency in the US dollar, down from 84% in 73, and the pound is like 6%. So things change. If you're asking me whether I think the reserve currency will continue to be the US dollar, the answer is I do. If you're asking me by 2040, 2050, do I think the US dollar as a reserve currency will be 59%? I don't. I could see it at 40%. My issue is what takes the place of the dollar. It sure as hell ain't the pound. I don't believe it's a euro. Lately it's been acting like gold is the reserve currency. Gold is up 23% this year. It was down today for the first time in I don't know how long. It was down 3.5%. But I don't see a viable alternative to the dollar. Remember, the largest capital markets in the world, if you want to borrow money, if you need to borrow real money, you ain't going to Europe and you're not going to Asia. You're going to the United States. So, until that changes, and I don't think it's going to change in my lifetime. Yes, I see the dollar continuing to trend down. If anybody's interested in this, my last note, you can find me on Substack, Rosen Report. It's free. My last note that I sent out Sunday, I have a beautiful video that I found on the internet that outlines the changing reserve currencies over time. And I think it's fascinating. And I wrote about it quite a bit. So you might find that interesting. I think that takes us to the end of questions. I don't know if there's anything else. We've been on for about an hour, so I don't know how long people want to hang out, but I'm happy to answer questions for as long as you want.
No, I think we covered everything, Eric. I just want to thank everyone for joining us. As a reminder, we'll be doing this once a quarter. We'll typically do this the middle of the month after quarter end. And obviously a lot's going to change between now and the next quarter. Things have been changing weekly. But thank you, everyone, for attending. We hope you found some value in it. And we'll also be sending out the recording of this by the end of the week or first thing next week for those of you that want to revisit for some more insight.
Well, Mike, thanks for having me. And I really appreciate everybody listening and asking such good questions. Having an engaged panel discussion makes it a lot more fun for me. So thank you for asking great questions. And everybody have a good day.